So we continue from where we stopped last week. We're discussing audit evidence. We introduced the chapter. We look at the meaning of audit evidence. And by the way, audit evidence, the relevant auditing standard is ISA 500. And we define audit evidence. We look at the element of audit evidence, that is sufficiency and appropriateness. We look at method of obtaining audit evidence. We discuss the method of obtaining um, testing, okay, for audit procedures, all those information they are going to test for audit. We talk about that. We also went further to look at test of controls and test of detailed transaction, as well as substantive procedure. All of that we explained last class. In that class also, we were able to explain the use of auditors experts, okay? ISA 620, and we also explained that even management too, they make use of experts. All of that were explained in last class. So we are going further today. I think last class we also look at financial statement assertions. We look at that also. So we are going further today. We are going to be looking at, we pick it up from we look at this one also. That is audit documentation. We look at that last class. So we've done all of that. When we talk about the permanent audit file and the current audit file, all of that were discussed last class. So want to see where we can start today. So let's start. Let's revise this one. Let's start from this side. ISA 550. Even though I know we have looked at that last class, I'll just recap from there. Then we'll move on. We are looking at related party and related party transactions. Okay. The highlight of that was that we said that um, you cannot do away with related party or related party transactions. Okay. And who are the related party, or what do you mean by related party transactions? Now, related parties are individuals, organizations that are expected or might have an undue influence on the company that is being audited. That is their connection, the relationship that exists between them and the company. They can be so overbearing such that it could influence the conduct of the audit engagement. So, the people that constitute related parties are the directors, okay, the key management staff of the company, their families, and other companies controlled by the directors, okay? So the main objective of this is that as an auditor, when you're auditing an organization or you're auditing a client, it's expected that you have an understanding of the relationship that exists. You have to ask them questions relating to related party transactions, okay? Then also, you must be able to obtain sufficient and appropriate audit evidence as regards those related party and related party transactions, because there is a risk in those related party transactions. The reason is that when we're talking about related party transactions, these are transactions that are not done at arm's length, all right? So there are some form of familiarity. There could be, let's say, for instance, there is a consulting job that is being done, and rather for them to charge a fair value, they will charge an arbitrarily high fee for such engagement. Why is that so? Because of the related party that exists between the client and the expert or the consultant that is performing the engagement. So these are the kind of fraud risk that you can find, because they are going to overbloat the uh, consultancy fee so that both the client and the consultant can have a fair share after the engagement has been completed. Okay. Then the most important thing is for the director to ensure that there is adequate disclosure and presentation of the related party and related party transactions in the financial statement. Okay. There is what? Adequate disclosure and presentation relating to related party and related party transactions in the financial statement. Okay. So that is for that. All right. So the next thing we need to, does anyone have any question for what we discussed so far before we continue? Any question? Any comments? Any question, any comments, class? Are we together? Can you hear me?
Yes, we can hear you. No comment.
Okay, so let's continue. So that's much about the related party and related transactions. So we are moving on to written representation, okay? Otherwise known as letter of representation. Now, what is a written representation? Okay, a written representation is a letter, okay, that is drafted, okay, by the auditor, okay, on behalf of the client to address areas that were not accessible or information that were not available to the auditor in the course of the engagement. So the letter is usually drafted by the auditor, but what we normally say, this is the way we always put it, we say that this representation is a letter that is prepared by the management. Why did you say so? So the auditor, in the course of performing the engagement, there are some questions that he needed to ask. There are some information that he needed to get. Okay. There are some documentary evidence that needed to be provided. And in some instances, or in most instances, this documentation are not provided. This information is not available. And because of the unavailability of the information or the non-provision of this information, it creates some form of limited assurance on the work performed by the auditor. So in a way to protect or to ensure that he has done the needful, you always request for a reason from the management why they are not providing that document or those documents and the information. So the reasons why this information is not provided or why those documents were not provided are what is contained in the letter of representation. So that in future, where there are issues, right, litigation, the auditor can use that as a form of audit evidence, even though it is a weak form of audit evidence. It is a weak form of audit evidence. Okay, but it will show that the auditor did ask the question or did ask for this information, but it was not provided. So the reason is that the management letter-headed paper, the complete letter-headed paper is what the auditor will use to draft the response. Because if the auditor were to leave the feedback or the response to the management, it's going to waste a whole lot of time. They'll be going back and forth. And that is why when auditor go to for any audit engagement, they always have a draft letter of representation in their file, in their audit working paper. So that when the need arises, all the just to do is just to speak with the management and send it to them. They will put it in their own letterheaded paper and the management will sign. So once the management signs, it is believed that it is the letter that originates from the management. So that is the main use of the letter of representation. Another use of letter of representation is the fact that there are times when the external auditor wants to confirm or validate the account receivable balances. Okay? In the course of trying to validate the account receivable balances, there will be a need to what? To circularize the debtors, the customers. So that first letter that goes out to the customers, explaining that they need to furnish the auditor with so and so information about the account balances. That first letter that goes out is they usually send it using the client's letterheaded paper. If they had used the auditor's letterheaded paper, nobody will oblige the auditor. So they will use the company's letterheaded paper, knowing fully well that it is the company that is sending the auditor to obtain such information. So, and in that instance, or at that instance, that is when they will respond. So that letter that goes forth before the data centralization is received, where they start receiving the balances from those customers, that is another form of what? Letter of representation. Because it's the letter that represents or that tries to validate whatever information that you have in the financial statement. Okay? So some of the areas where you need letter of representation include non-current assets, right? Liabilities, investment. Now, why do you need organization for non-current assets? Now, sometimes, I said that is a way of what? Obtaining information. So if the company has inflated the figures or the balances they have in the non-current assets, the auditor can write the manufacturer or the seller or the distributor of those assets to confirm whether the value they have put in the financial statement is correct or wrong. All right. The same thing with liabilities. You are owing the company is owing a bank. The auditor will write the bank on behalf of the company to understand how much or if truly that liability exists. The same thing with investments, the same with receivables, the same thing with contingent liabilities, legal claims, and deferred taxes. Okay. Now, if management refuses to provide the letter of representation or written representation, then the auditor will need to follow these procedures. First of all, he needs to sit with the management to understand the reason why they don't want to provide that information. That's number one. Number two, when he sits with them, he will be able to reevaluate the integrity of the management. He will be able to do what? Reevaluate the integrity of the what? Of the management. Then in that instance, in evaluating the integrity of the management, we will to understand whether he can rely on other information or other audit evidence that have been obtained or provided by the management. If they cannot provide the information, it casts doubt on their what? On their integrity. And above all, where all of these are not done, ultimately the auditor is going to do what? The auditor is going to qualify his audit report. And when he qualifies the audit report can either be an except for audit report or it becomes what? A disclaimer audit report because they did not provide the necessary information. I hope we are getting it. So those are the procedures that need to be followed to ensuring that the letter of representation or written representation is obtained. Okay. Then last time also, I don't know that I think we look at this, but I can still go back to it. Using the work of an auditor's expert. Who is an expert? I said that both the management and the auditor they make use of the expert. So expert in audit is not the same definition as you have it in lexicon in your dictionary or in our dictionary. There is a name, there is a way we define expert in audit. And these are some of the reasons why students fail audit because they want to replicate their knowledge of experts in dictionary to defining experts in auditing. And these are completely different things entirely. They don't relate at all. So according to ISA 620, an expert is someone or an organization that has skills, knowledge in other fields outside accounting and auditing. Any organization or individual that possesses knowledge, skill, and experience in other fields outside accounting and audit is an expert. Okay, so for instance, you want to value your assets, you use an expert. It has a valuer or you use a quantity surveyor. You want to seek a legal opinion, you use a lawyer. You want to value your funds, your retirement savings funds. You want to value your assets. You want to value your assets. All of these are done by experts. All right. But one thing you need to realize is that the determination of whether you're going to use an expert in the course of an engagement is determined right from the planning stage. Remember, I talked about that at the planning stage. The time whether you're going to use or you're going to need an expert during the what? The planning stage. And in the course of trying to get the experts on the engagement, there are certain things you need to consider. Number one, you need to consider the nature, significance, and complexity of the matter. You need to consider the nature, significance, and complexity of the matter. Two, you need to look at the risk of material misstatement. Now, what do you mean by the nature, significance, and complexity of the matter? Now, if you are looking at a contingent liability, for instance, that is contained in the financial statement. A so contingent liability is a liability that the result, the outcome is yet to be what to be determined. It could be in favor of the organization or other way around. So the nature we need to understand, we need to understand that whoever is going to seek opinion from or you're going to seek advice from as regards contingent liability is someone that understands the nature of the liability. The person should understand the significance of the contingent liability. The person should understand the complexity of the liability. And also, more importantly, the expert should also understand the risk of what? Material misstatement, because that information should be what? Should be reasonable. Whatever information, whatever amount that has been put as contingent liability should be an amount that is what? That is reasonable. Okay? Then another factor that the auditor will need to consider when trying to assess the expert is to understand the availability of alternative sources of audit evidence. You should not be able to look, it should not be stereotyped. Okay? You should be able to have other alternatives to corroborate whatever he has gotten from the client. Remember when you talk about method of obtaining audit evidence, we talk about what? External confirmation. There's some information you get from the client, you need to what? Corroborate them. You need to look for other alternative sources of audit evidence that will confirm whether the information you got from the client is accurate or not. All right. So once this is done, you now think about bringing in the experts. Now, in bringing in the experts, the auditor must have an understanding that there are certain things he needs to bring to the knowledge of the what? Of the experts. Number one, he must have an understanding of the expert field of expertise. Because the risk of this using the work of an expert is that at the end of the day, the auditor takes full responsibility for the report provided, submitted, presented by the expert. I take it again. The risk of using an expert, auditor's expert, is the fact that the auditor takes full responsibility for the work done by the auditor's expert. It is the auditor that is going to present the expert report to the management or to the client. That means that he must have an understanding of how the expert has carried out the work. Number two, the auditor should agree terms of engagement with the expert, including scope, objective, expert report, and confidentiality requirements. Like I said, unless the law permits, the expert report is presented by the auditor. It takes full responsibility for everything. In fact, when it's presented, it's not going to say that based on the report I obtained for, it's going to say based on my report, because it's the one that has brought in the expert. unless there is a need and the law requires that the expert should come and say something. That is when you can have a deviation. Otherwise, the external auditor takes full responsibility for the work of the auditor's expert. So in the course of selecting the expert, you must understand whether the expert has what adequate knowledge about that his field. For instance, if the auditor wants to take contingent liability opinion or advice from a legal practitioner, he's not going to ask someone that just graduated from the Nigerian law school. He's not going to ask somebody that has spent just 3 years practicing law. You rather go and seek expert knowledge from the senior advocate of Nigeria that has specialization in that area. Because you know that law is broad. Law is very, very broad. So you must seek people that have what experts and that can look at issues from 360, from the angle of what 360, all around that. That is the person the auditor will go and seek information from. And these are the things that make the auditor to be very, very robust. Make the auditor to be what? Very, very knowledgeable. Because the auditor is someone that knows so much of everything. Okay? So other things the auditor will also need to check, like I said, is the competence of the what? Of the expert. How will he check the competence of the expert? He will look at what? His personal experience with previous work of that expert. We need to seek reference, professional reference from other people that the expert has served. We need to discuss with the expert, okay? We need to discuss with other people that are familiar with the work of the what? With the expert. Then we will look at the what? The knowledge of the expert qualification. Is this person qualified? Did he finish from law school, just for instance? Did he finish from the university? Okay. For instance, if he's seeking opinion from an architect, we need to check. Is that person a member of the Nigerian Institute of Architects? Or if he's a lawyer, we'll check. Does that person belong to the Nigerian Bar Association? What is his number? Okay. All of these are what the auditor will look out for before he decides on the type of expert he will rely on. Okay? Then, does anybody have any question before we proceed? Is there a question, comments, observation? I want to believe that everybody is clear. So let's continue. So that's all about the auditor's experts. Okay, we'll go to the next area. Reliance on the work of the internal auditor. All right? Reliance on the work of the internal auditor. Now, in the course of performing the audit engagement, especially where you have an organization that uh, that has an internal audit department, where you have a client that has an internal audit department, the work of the internal auditor is supposed to make the life of the external auditor easier because the internal auditor is supposed to be the support system for the external auditor. Okay? The internal auditor should be the support system for the what? For the external auditor because most of the information he needs would have been provided by the internal auditor. So what that does is that it makes the audit to be more efficient and more cost effective. Okay? But what we have found out is that in most organizations, even though they have internal audit departments, internal department is not functioning optimally. Most time, They just have the internet department just for what? For regulation's sake. Because of corporate governance, we must have internet, they could just put it there. But the department is not optimally functioning. All right. So what the editor, before the external auditor can rely on the work of the internal auditor, the external auditor is going to evaluate the existing internal audit department. What will it do? Number one, is going to check the what? The status of the internal audit department within the entity. What does that mean? You look at the independence and objectivity of the internal audit department. Even though we know that there is some level of subjectivity in the work of the internal auditor, because it cannot, most times it cannot go outside the scope that has been designed, okay, for them or for the department. And it's the management or the board of directors or the audit committee that design this scope of work. So we need to look at it to see that does the internal audit department have some form of what? Independence. And mind you, the independence you are going to get from internal audit department will not be the same as the one that you get from an external department, because external auditor is not a staff of the organization, whereas the internal auditor is a staff of the organization. I believe we have done internal audit and outsourcing. We have been able to see the difference between internal audit and external auditing. Another factor that the external auditor we use to evaluate the internal department is the technical competence and due professional care of the internal auditors. Are they putting square pegs in square holes? For instance, you have somebody that read zoology, heading the internal department, and he or she has not gone for further studies in financial related discipline. He has not taken any program organized by ICAN. You put that person at the helm of affairs of the internal department. That cannot work. Okay? Then the external auditor will also look at the communication that exists, the level of communication that exists between the internal department and the external department, especially when meetings are held. Especially what? When meetings are held. You know, communication, we say that communication is not complete until what? Until when there is what? When there is feedback. When the external auditor is not getting the right feedback from the internal department, we assume that the internal department is not functioning. You will look at the nature and scope of the specific work performed by the internal audit. So at the end of at every point in time, the internal department, they have their internal audit plan and they have their report. And in their report, you have observations, you have recommendations. In that report, how many of those recommendations have been implemented? This goes a long way to determine whether it's going to rely on the internal audit or not. Okay, it's also going to look at the adequacy of the audit evidence obtained in their audit report, because the audit report, they're going to talk about how you have obtained your audit evidence. The auditor will review the audit evidence and see whether they are what, whether they are adequate. Then another thing that the external auditor will also use to assess the internal auditor work before you can rely on the work of the internal auditor is to look at how he is able to arrive at his conclusion in his audit report. Because in every audit report, you have a conclusion. And those conclusions, the external want to check, are they consistent? So when the internal look at all of this, we're able to conclude and say, because it's going to affect this, because all the external, like I said, they don't just work on what? On guesses, inferences, no. They work based on what? Based on documentary evidence. So if after the evaluation and they see that all of these areas were not properly covered by the internal department, they are going to set the internal department aside and carry on with their audit engagement as though the internal audit department never existed. Okay? So that is what they will do. I hope we are cleared. Any question? Any comment? Any observation?
Yes, sir.
Okay, so thank you. So we go on to the next area, audit of accounting estimate. You go back to your IS 8, talking about accounting estimates, provisions, and prior year adjustments, right? You see that in that standard, we're talking about accounting estimates. So when you talk about accounting estimates, what it means is that it's an approximation of a monetary amount in the absence of a precise means of measurement. So what does that mean? It means that for you to have talked about accounting estimate, that means you don't have the actual figures. You don't have the actual amount. You don't have the actual balances. Hence, you are going to do what? You are improvising. Hence, you are doing what? You are approximating. Okay? Now, what the auditing standard says here is that there are so many aspects of the financial statement that poses risk, that poses fraud risk to the what? To the auditor. Or that could result in what? Material misstatement in the financial statement. And those areas where you utilize estimates, accounting estimates are in accruals, repayments, depreciation, deferred taxes, construction contracts, contingent liabilities. These are some of the areas where you utilize accounting estimates. And these areas that I just mentioned, if it's not properly evaluated, it could impose a risk of material misstatement on the financial statement. So what the auditor is supposed to do when it comes across these accounting estimates, because you cannot rule it out. You cannot rule out the use of accounting estimates in financial statements. You cannot. So what the auditor will need to do is to obtain sufficient and appropriate audit evidence as to whether the accounting estimates are reasonable or realistic. You cannot put a bogus figure in your financial statement, say you are trying to estimate something. That figure you have put there, that balance you have put there must be what? Must be realistic. Okay? Then the auditor will also want to check whether the clients have made enough disclosures. They have made adequate disclosures to back up or to support the what? The estimate. For instance, you look at the budget in every organization, they always have what? Budget assumptions. If you look at the assumptions, you are going to see it talks about how they arrive at their sales revenue, okay? How they arrive at their what? At their expenses, how they are going to discuss, how they are going to calculate the staff cost for the year. They are going to embark on any capital expenditure, they're going to talk about it there. So while you are looking at the financial statement, you'll be asking for some of this information. Because when this information is not provided, it casts doubt on the integrity of the management. Okay? It casts doubt on the integrity of the management. So the auditor should ensure that at all times, when it's checking the accounting estimates, it should check that the estimates are reasonable and adequate disclosures have been what? Have been made. Okay? Adequate disclosures have been what? Have been made. I hope we are together. So we go to the next area of the, we go to the next area. Now, this next area, like I said, is the area that has to do with the audit of the specific area of financial statements. I think I said that I'm going to send a summarized view or summarized note on this aspect. Okay. So I'm going to send a summarized note on this aspect. So I'm going to send that by the end of the month. We have looked at audit reporting, right? We look at audit reporting last class. So today we'll be going to the next topic on the agenda, which is the current issues in auditing. Current issues in audit, that's chapter 15. Okay, let's look at current issues in auditing before we come back to this assurance and services. Current issues in audit, chapter 15. Now, what do we mean by current issues in auditing? Now, auditing is audit and assurance services is a profession that is always evolving, all right? So every now and then, there are new developments in the audit and assurance services. So those are the things we want to look at here now. The first we want to look at under this chapter is regulation of auditing, an ethical framework or a rule book. So what this one means is that if you look at audit and assurance services, okay, there are two approaches that you can use. What are the two approaches? Either you use ethical framework or you use a rule book approach. What do you mean by ethical framework? Ethical framework sets what? Set out principles that should govern the behavior, okay, or reasoned argument to support the principles. So you talk about ethical framework. You are looking at what those fundamental principles that have been put in place. Those fundamental principles that have been put in place to regulate or to guide how the auditor comports themselves. When you talk about the rule book approach, what we are saying here is that these are set of rules about what must and what must not be done, the do's and don'ts of an external auditor. You can see that it's different. One talks about all the do's and don'ts of the external auditor. The other one talks about the principles that should guide the behavior or conduct of the external auditors. So those are the two approaches that we have. Now, if you look at the second one, that is the rule book approach, you will see that there can be no compendium, there can be no document that can contain all the do's and don'ts in the practice of auditing. You can't have that book. You cannot. Because every day you discover new things. Is it every day you're going to be revising that material? The answer is no. Imagine you have the ICAN code of conduct, code of conduct that spells out the do's and don'ts. ICAN was established in 1965. Okay? And they have these do's and don'ts. By now, if ICAN has been using that method, we will have lost count of how many volumes of books or material on code of conduct that this will have published. Because every now and then they'll be churning out new regulation, which might not go well for the practice of audit and assurance services. And sometimes when you want to review or you want to revise this document, before you revise any document, you have to get hold of the initial one, the original one. So imagine the last time, ICAN started in 1965, okay? And it goes and goes 1965. They want to make some amendment to it. But they have had several volumes after that. But there is a particular one they want to make reference to in 1965. That means it's going to be very, very tasking for whoever is going to do the review to be able to get hold of that first one, that initial publication that contains the information that needs to be revised. So it's very, very challenging to revise or to use a rule book approach in case when you want to do what you want to do some form of what? Revision. And you need to understand that there cannot be a one cap fits all for all situation. I hope you understand. You cannot have a situation that said that, everything you need to know about this profession is in this material. It is not possible. Because every day there are new developments. Okay? So to guide against some of these problems, that is why the profession, the Audit and Assurance Service, they decide to adopt the ethical framework approach. Because the ethical framework approach, what it does is that it simplifies the practice of audit. How? There are certain principles you need to follow as an external auditor. Follow those principles and you are fine. So rather than for them to be giving you, to be micromanaging the external auditors, the rule book, the ethical framework approach gives them what? The liberty to act within the ambit of what? Of those principles, of the framework. For instance, how do you define integrity? For you to talk about integrity, reduce a lot of integrity, you can use over 100 pages to discuss integrity. And without mincing words, you continue. You'll be using over 100 pages to discuss what, or to explain what integrity as a professional. But once you have imbibed the principle as a professional that you must have integrity, everything that has to do with integrity, you abide by it. Nobody is going to tell you. So any act of the professional should be the professional be able to judge, to evaluate whether it's an act that has breached integrity or not. So you just abide by the what? By the principle. But is it confidentiality we want to talk about? Don't talk about confidentiality. You can talk about confidentiality from now to tomorrow. And you are not going to miss any words. You are not going to repeat anything. You are going to continue. But to avoid all of this delay, right? What you need to do as a professional is to do what? Is to imbibe these ethical principles. And those are the fundamental principles that we discussed in chapter 3 under the rule of professional conduct. The integrity, objectivity, confidentiality, professional behavior, technical competence and due care, independence, conflict of interest. Those are the ones that we discussed. Those are the principles they are talking about here. Okay? So that is the reason why they have adopted. And if you go to most other professions also, medicine, pharmacies, architects, all of them, they have also imbibed the ethical framework approach. Why? Because it's easier to manage. And it allows for what? Ingenuity. It allows for what? Ingenuity. It also allows for what? Freedom. You are not caged. You are not bound by, you are not caged that you cannot think outside the box. You are able to what? To think outside the box when you are acting within the ambit of the law. Okay? So that about the first area we look at now, the regulation of auditing, an ethical framework or a rule book approach. So we go to the next area. We look at the area that talks about the Sarbanes-Oxley Act. Okay, we are talking about independence of the auditor. We are looking at what? The independence of the auditor. How do you ensure independence of the auditor? Remember that one of the causes of corporate failure in the US in the early 2000s is the is what? The breach of what? Independence. Breach of independence of the what? Of the external auditor. The breach of independence of the external auditor. Once the external auditor is not independent, it's going to affect his engagement with the client. And because of that absence of independence was what led to Enron Corporation saga, WorldCom saga, Merrill Lynch saga. All of this happened in the early 2000s. And that was why in US in 2003, the Security and Exchange Commission in US implemented the Sarbanes-Oxley Act of 2002 that gave rise to what? Corporate governance. Because with the corporate governance, it spells out the do's and don'ts for the parties that's supposed to safeguard what? Corporate governance. And who are the parties supposed to safeguard corporate governance? The directors, the board of directors, the management, audit committee, and external auditor. So it spells out what each and every one of them should do, what role they should what they should play. So in the US, one of the ways to safeguard the independence of the external auditor is to ensure that while the auditor is the one auditing the financial statement, it cannot carry out any other audit services. It cannot carry out any other assurance services for that same client because it is believed that if it does, its independence will be what? Will be impaired. If it does, its independence will be what? Will be impaired. So in US, once you are the external auditor, that is the only thing you can do with that client. Other services you cannot render to the client. But that is in US, not applicable in Nigeria because Nigeria is not an extension of US. So in Nigeria, one of the things that we do, one of the practices is that once you are the auditor, you are the one auditing the financial statements of a company or of a client company, you can carry out other services, provided you are not using the same engagement team for these other services. So let me explain. So you are the external auditor of the company, ABC Nigeria Limited. Now, they also want you to carry out internal audit outsourcing function for them. So what that implies is that whoever is going to be involved in the internal audit outsourcing function should not have been a member or should not have been part of the team that carried out the audit engagement. That's what we mean. A separate person, a neutral person should handle it because once you allow the person that partakes in the audit to also be in charge of internal audit outsourcing, it's going to lead to what? Complacency. You will not be able to be thorough on the job. He will do the job shabbily because he believes that it is not long ago that he reviewed the transaction. You understand? So in Nigeria, we also, as a way of safeguarding the independence of the auditor, the external auditor, we have introduced the Security and Exchange Commission and the Institute of the Chartered Accountants of Nigeria. They have introduced what we call rotation of audit partners. We call it what? Rotation of what? Audit partners. So what that implies is that as an audit firm, when you send your engagement team for an audit engagement, the engagement team, right, the leader of the engagement team can only lead that engagement for a specific number of time. You can lead the engagement for what? A specific number of time. Usually, we say like 3-4 years. If he does it for 3 years, by the fourth year, you will be redeployed to another engagement. Okay? It will what? Redeployed to what? Another engagement. Why? Now, the reason is that if they allow the same engagement and the engagement partner to continue, you get to a point that he will not be doing anything again. He will not be thorough in his job. complacency will set in. So as a way of avoiding complacency, such engagement partner will be redeployed to other engagements, while a new engagement partner will be brought in to take off that charge or to take charge. So that period that is away is usually called what? The cooling off period. It might still come back, but they want the person to be, not to relax, not to be too idle or to be too comfortable with the client information. So they will allow the other one, the former engagement partner, to be away for like 3 or 4 years before they bring the person back again. So when he's coming back with a fresh mind because a lot of things would have what? Would have changed. Because what? A lot of things would have changed. Thereby, his independence would be what? Would have been protected or safeguarded. Okay? That's the first one. We call it audit partner rotation. Now, the second area where you can also safeguard the auditor's independence is the use of what? Audit firm rotation. Audit firm rotation. What do you mean by audit firm rotation? Now, audit firm rotation arises where the audit firm itself resigns his appointment with or his engagement with the client. So, as part of the recommendations in the CAMA, Companies and Other Matters Act 2020 as amended, there's a provision that says that the auditor, the external audit firm, or the external audit firm that is auditing the client can only audit a limited liability company for a maximum period of what? 10 years. After the 10th year, a new audit firm should take charge. So that is, once the auditor audit a company that is a PLC, such audit firm can only audit that client for a period of 10 years. But if you continue to audit that client, it's going to lead to what? Familiarity and complacency will also set in. But for private liability company, all those private companies, there is no limitation. Because I've worked in an organization where the auditor has been working for them for over 30 years. There's no limitation in that regard. I hope you understand what I'm saying. So all of these are measures put in place to safeguard the what? The auditor's independence. Okay. All of these are what we put in place to safeguard what? For what? Auditor's independence. So there are arguments in favor of audit firm rotation and arguments against audit firm rotation. Okay? So what are the arguments in favor of audit firm rotation? Number one, in a long-term audit relationship, the auditor may become too close to management of the company. And this may weaken the professional skepticism and what? Independence. Remember, I've talked about that. All right? Now, if rotation would not protect the independence of the audit firm, it improves the what? The public perception of independence. That people will look at the audit firm and say that, oh, these people, they are what? They are independent. Argument against audit firm rotation. Number one, there may be negative effects of audit on audit quality. That is, because you are changing from one audit firm to the other, at the initial stage, the quality of the audit job might be what? Might be affected at the initial stage. Then subsequently, it's going to build capacity. All right? Another thing again, when you change your audit firm, it's going to affect the what? The cost. You can't expect the new audit firm to take the audit fee that the outgoing audit firm receives. No. And this is going to lead to what? Increase in what? In cost. Okay? It's going to what? Lead to what? Increase in what? Increase in cost. So those are some of the advantages and disadvantages of what? Audit firm rotation. Okay? Is there any question, comment, observation? Any question, comment, or observation? The next area I want to look at now is called transnational audit. Transnational audit, as the name implies. Transnational. What is transnational? Transnational means across. All right? That is across nations. So a transnational audit is an audit of financial statements which are or may be relied upon outside the audited entity's home jurisdiction for the purpose of significant lending, investment, or regulatory decisions. Okay? What do we mean? So let me give an instance. You have Nestle Nigeria. We have Nestle in Netherlands. That is their home country where Nestle came from. Okay? Holland. Now, where, let's say Nestle Nigeria wants to obtain a loan from the bank for expansion. Because the bank is aware that Nestle Nigeria has a parent company in Holland. The bank will not only be interested in the financial statement of the Nestle Nigeria. Rather, it's going to request for the financial statement of the holding company in Holland. Why do you think this is necessary? Now, why this is necessary is the fact that in case the one in Nigeria, in case Nestle Nigeria cannot pay due to one thing or the other, the holding company, the parent company in Holland will step in. Okay? So that is the loan that the money you want to collect for expansion will not go what? Will not go bad. You understand? So transnational audit is an audit, like I said. You're auditing the financial statement, okay, of another company or a company that is domiciled outside the entity's main jurisdiction for the purpose of what? Significant lending, investment, or regulatory decisions. So these audits are performed by uh, a selected, experienced team of transnational auditors. We call them transnational auditors. That is the area. Is a specialization in audit. Okay, it's a specialization in audit. Okay, so with that takes us to the next one, the transnational audit committee. Now, this is a committee. This is a fallout. Is a continuation of this transnational audit. A transnational audit committee is a committee that's been made up of what? Transnational auditors. Okay, it's a committee made up of what? Transnational auditors. So what do they do? So transnational audit committee, like I said, is a committee of IFAC that it is represented in the board. That is the International Federation of what? Accountants. Okay? So what do they do? Because they are part of the board of IFAC, they identify audit issues with what? Audit practices. They ensure that all those areas of improvement during practice are what? Are worked on. Okay? Number two, because they are a bunch of professionals and they also want to promote good global practices in terms of what? Quality control, audit practices, independence, training, and development. They also make advices or give advices to IFAC on how this can be done. Okay? Also, they play a crucial role whenever they want to do what? They want to set new auditing standards. They want to set what? New auditing standards. All right? So when they want to set new auditing standard or they want to set new accounting standard, this transnational audit committee, being a member of IFAC, they now come to what? To review or to contribute to such development. Okay? And lastly, they serve as what? A conduit pipe. A conduit for what? For interaction among transnational firms and international regulators. So when you have companies that are located internationally, you have firms that are located transnationally, this transnational audit committee serves as what? As a bridge. It connects transnational firms, international regulators, and financial institutions, especially in areas of what? Audit quality and what? Transparency of international networks. Okay? So that's all about transnational audit committee. Any question? Any comments? Any observation? So we go to the next area, audit of small companies. Audit of small companies. Now, remember that in the amended Companies and Allied Matters Act 2020, that clause that says that all companies, whether small or large, should submit themselves for what? External auditing. That clause has been removed. Okay? I take it again. If we look at the amended Companies and Allied Matters Act 2020, before that amendment, all companies are subjected to external audit every year. But with the new amendment to that hammer that we call the Companies and Allied Matters Act 2020 as amended, right? That clause has been removed. Rather than making it mandatory now, it is now what? Optional. Not a must. All right? Now, one thing we need to know as ICAN students is that you need to be able to understand or appreciate what are the importance of subjecting an organization for a statutory audit, and what are the implications or the disadvantages or advantages of not subjecting the organization to what? Statutory audit. That is what we are looking at here. Okay? You hope you understand what I'm saying. Now, if you look at our Finance Act, if you look at our Finance Act, in fact, the latest finance amendment to the finance, to the tax legislation, the reform tax law that we are trying to pass for 2025, right? We have two categories of companies now. We have companies that are, when they say a company is small, any company that has a turnover of, I think it's less than 50 million, is a small company. You only have a small company and a large company now. So those that their turnover is above 50 million, they are seen as what? A large company. Okay. Now, for companies that are small, remember, I said that the law has made it what? Flexible for them. So they are now exempted from what? From statutory audit. Okay. So let's look at Let's look at the argument for audit exemption for small companies, okay? An argument against audit exemption for small companies, okay? Now, let's look at the first one. Argument for audit exemption of small companies. One, audit costs are high. That is, the resources could be spent by smaller entities to obtain more useful financial services. That is why that this one is this area we're looking at advantages of what audit exemption. Okay. Number two, reason providers of loan finance will normally attach their own specific conditions to borrowing, and these conditions are often independent of the content of the borrower's financial statement. Once you take a loan from the bank now, aside from looking at your financial record, they are going to do what we call due diligence on the company. The credit risk department of the bank, they have their own metrics. They have their own risk management metrics that they are going to deploy to evaluate whether the organization will be granted credit or not. So they don't only focus on what? On the audited financial statements. That's another advantage. Number three, filing deadline for the account of smaller entities are often too long after the reporting date. The reason is that, in Nigeria, we said that for the bank now, by next month will be the last month or the final month they're expected to present the financial statement for the previous year. So they have 3 months after the year end to prepare and present the audited financial statement. What we are saying here is that 3 months or sometimes 6 months is too far a period, because within 3 months or 6 months, so many things will have changed. There will have been amendments to government policies, there will have been amendments to regulations, and this will impact on the financial statement already prepared. So it makes it what? Useless, or make it what? Out of date. Okay? Then another advantage is that many countries allow small companies to publish abbreviated financial statements, or we call it abridged financial statement. So you don't need to show us everything because your company is small. Just prepare a summarized financial statement for what? For publication. Okay? So those are the arguments for, which is more like advantages. Now, what are the arguments against audit exemption, especially for small companies? One, an audit provides an assurance that financial statements provide a true and fair view and do not contain material misstatements. So this is a key check. This is one of the key checks in what? In auditing financial statements, because it tends to give an assurance that financial statements do not contain any material misstatements. Another disadvantage is that the audit is valuable, especially for user group other than the shareholders. Now, how do you expect the other stakeholders, other minority interest, those other categories of shareholders that do not control the shares of the organization? How do you expect them to have assurance that their investment is intact? It is only through the audit the audit of financial that they will be able to see that, yes, my investment in this organization is what? Is intact. Okay? Number three, for regulators, the government regulators, they don't joke with audited financial statements. For instance, FRRs, they always ask for your what? Your audited financial statement. Okay? Banks, we always ask for audited financial statement. Industrial training fund, we always request for a what? Audited financial statement. And some other government regulators. So audit is very, very important. Then another argument against audit exemption is that by carrying out or by performing audit or financial statement, it serves as what? As a deterrent. Deterrence to what? To people that want to perpetrate fraud. Oh, somebody is going to come after me if they check my books and my books are not correct. That alone is a deterrent to what? To fraud. Okay? That alone is a deterrent to what? To fraud. So those are the arguments for and against small companies exemption from what? From audit. All right? Any question? Any comment? Any observation? Okay, let's quickly look at this aspect. Audit of smaller entities is still in line with what we are just finished discussing. Now, if you want to audit a small organization, the issue is that first of all, you must have gained understanding of the client business, how the business operates, before you design your what? Audit approach. And when you design your audit approach, you are likely to make use of what? The substantive testing audit approach for a smaller entity. All right? Why are you making use of substantive testing audit approach? Because you know very much that the internal control in some of those smaller entities are usually what? Weak. Is what? Is usually what? Weak. Because one person might be involved in so many things, and that means that there is no segregation of duty, and that can lead to what? Fraud or error. Number two, thing you need to have at the back of your mind, or the issues that you have, the challenges that you have when you're auditing small entity, is the fact that the owner of the business takes full control of every affairs of the organization. They are the one in charge of decision making, they're in charge of making payment, they are the one in charge of procurement, they're in one in charge of what? Making sales. Everything that happens in the organization evolves around them. So that makes the internal control to be what? Very, very weak. All right. The other thing that another major challenge with small companies is the fact that they have poor record keeping, because the people that are at the helm of affairs do not understand the importance of documentation. So record keeping is what? Is usually poor. And this weakens the internal control system. All right. So the audit approach is the next thing we need to look at. What's the audit approach? I've talked about the society testing audit approach, right? Then after you have done that, you are going to develop your audit plan, and you must ensure that your audit team is what? Is usually small, because the organization you are going to audit is not a big organization anyways. Then you need to look at the what? The accounting system. The accounting system will be very poor. Why? Because there is poor documentation. Because of poor documentation, the internal control cannot be relied upon. So most of the work will be based on what? Substantive procedure. What substantive procedure? You are going to make use of test audited transaction and analytical review procedure to be able to evaluate the risk of material misstatement in the what? In the financial statement. All right. You might not be able to obtain quality audit evidence. Why? Because of poor documentation. Then, more importantly, The provision of letter of representation is usually very, very important, okay, for small entities because most of the information will not be provided. And for the auditor to have some level of assurance or reasonable level of assurance, you will need to depend on obtaining this letter of representation as a form of what evidence to show that some of this information was not provided and hence the reason why he cannot give an appropriate opinion on the financial statement. All right. The other thing the auditor will also need to look at in the course of the auditing the small entities is to test the going concern of the business. Okay. So, but what happened here is that for small entities, they are on the risk of what? Risk of collapse. Why? Because the owner of the business, they are always looking for opportunities to expand. And sometimes they might not have done their due diligence before embarking on such mission, which at the end of the day would affect the survival or continuity of that business. So the auditor must always ensure he checks the going concern of the business by sitting with the management, try to understand what are the projects that they're embarking upon as a way to ensuring that this company can continue for the next 12 months. And because of the non-provision of the documentation or poor record keeping, the auditor will need to what? Qualify his audit opinion. The auditor will write audit report. The audit report will what? Will be qualified because of what? Inability to obtain sufficient and appropriate audit evidence. All right. So the auditor will still look at the financial statement in line with what? IFRS. Okay, you still look at it, but you see that most times they will not comply with some of those standards. Why? Because they are small. Okay, and another thing is that most of the people that are at the end of affairs, they don't have the technical competence of how the international financial reporting standard operate. So it's going to affect the what? The financial statement. So that is how you audit the small entities or small companies. Any question, any comment, any observation?
No, sir.
Okay, we go on to the next area, social and environmental reporting, or we call it sustainability report. Okay, so ISA 250 requires the auditor to obtain sufficient appropriate evidence in respect of non-compliance with laws and regulations, which might be expected to have a direct effect on material amounts and disclosures in the financial statement. Okay? Non-compliance could be over a variety of social or environmental matters, such as health and safety, equal opportunity legislation, and anti-pollution legislation. Now, what we are saying here is that as an organization, more emphasis is being placed on the need to report on sustainability report. And sustainability report is a combination of your social report and environmental report. That is how the company has contributed socially to its host community, as well as how the company has contributed environmentally to the what? To their host community. And this provision of this report could be an avenue to reducing the taxes that the companies will pay at the end of the financial year. While Dangote was constructing most of the roads in Nigeria sometimes ago, about 4 years ago, he got a waiver from the government. That is because he has accepted the project to reconstruct or to rehabilitate most of the roads in Lagos and some areas. He got a waiver, he got a tax credit from government. He was able to show that he has contributed his own quota to making the environment to be what? To be more, to be safer. And he also contributed socially to improving the welfare of the people. How? All the people all the laborers, for the period while the project lasted, he was paying them. For the period while the project lasted, he was doing what? He was paying them. So somehow, the payment for their labor or their wages is a form of what? A social benefit. Okay? So as organization, there is a need to have a section in the annual financial statement that talks about sustainability reports. So in looking at sustainability reports, we'll be looking at let's start with the first one, environmental audits. Now, I want to ensure that the organization is not contributing to further degrading the environment or exposing the environment to further harm. For instance, by releasing toxic chemicals or gases to the atmosphere. Okay? We must be able to protect the environment such that their activity, okay, the activities do not affect the inhabitants of their host community. All right? So they should be able to do what? Recycle their waste properly. They must comply with environmental regulations. Okay? They must ensure the source raw materials that are what? That are environmentally friendly. Okay? The source raw materials that are what? That are what? Environmentally friendly. Then we look at the other one, the social reporting. Now, social reporting, the auditor will want to look at how has the company contributed to improving the economic welfare of the host community. For instance, by providing employment for the host community, by providing healthcare to the host community, by providing libraries to the host community, by giving scholarship to indigent students in the host community, by giving employment to physically challenged in some aspect of the business that does not warrant um, physically fit person to handle. All of these are ways the organization can portray that one way or the other they have contributed immensely, positively to improving the economic, social, and environmental well-being of the people in the host community. And this aspect is contained in what we call what? The sustainability report, or we call this corporate social responsibility report, that is contained in the accounts and report of companies, especially for the publicly listed entities. They can't shy away from it. Once you're a PLC, you have to contribute your own quota on how you have improved your host community, environmentally, socially, and economically. Okay? So with that, we are done with Chapter 15. Any question, any comment, any observation? So this is Advanced Audit and Assurance, May 2015. Question number 1. This question is about audit reports, okay? Now, the section A, compulsory question. You are the manager responsible for 4 clients of Nnamdi and Co., a firm of chartered accountants. The year end in each case is 31st December 2014. So what that means is that we are looking at an audit firm named Nnamdi and Co., chartered accountants. Okay? Now, you are currently reviewing the audit working paper files and the audit senior recommendation for the auditor's report. Details are as follows. The first client, Ray Company Limited, a subsidiary of Sun Group. Serious going concern problems have been noted during this year's audit. Ray Company Limited will be unable to trade for the foreseeable future unless it continues to receive financial support from the parent company. Ray Company Limited has received a letter of comfort from Sun Group. The audit senior has suggested that due to the seriousness of this situation, the audit opinion must be at least be a qualified except for. We have looked at audit report last class. Qualified except for. All right? I hope you understand. The second one, Intangible Limited has changed its accounting policy for goodwill during the year from amortization over its estimated useful life to annual impairment testing. No disclosure of this change has been made in the financial statement. The current amount of goodwill in the statement of financial position as at 31st December 2014 is the same as the previous year. As management impairment test shows that it is not impaired. The audit senior has concluded that a modification of the opinion is not required, but suggests that attention be drawn to the changes by way of emphasis of the matter. Paragraph. We have looked at that also. The third one, Director's report of Shelters Limited states that investment property rental forms a major part of revenue. However, a note to the financial statement shows that property renting represents only 1 to 6% of total revenue for the year. The audit senior is satisfied that the revenue figures are correct. The audit senior has noted that an unmodified opinion should be given as the audit opinion does not extend to the director's report. Remember, I've talked about that other areas of the audit report that the auditor needs to look at. I looked at that also last time, in the last class. The next one, audit work on the after date bank transaction of Star Limited has identified a transfer of cash from Chicoin Limited. The engineer assigned to audit of Star Limited has documented that Star Finance Director explained that Chicoin Limited commenced trading on January 7, 2015, after being set up as a wholly owned foreign subsidiary of Star Limited. The senior has noted that although no other evidence has been obtained, an unmodified opinion is appropriate because the matter does not impact on the current year financial statement. Required for each situation above, comment on the suitability or otherwise of the auditor senior's proposal for the audit report. Where you agree, indicate your audit modification, if any, will be given instead. 30 marks. Now you have a question like this. This question, you have to read it like 2-3 times. First of all, when you are giving a question in the exam, The first thing you need to realize is that where is this question coming from? From which topic is this question coming from? That will give you a guide on how to go about it. These questions that we have looked at now, all of them, they come from chapter 14, reporting, audit report. That means that you must have understood what is meant by audit report. Everything that you need to know about audit report should be in your brain now, processing it. Secondly, you need to read this case study like 2 times to have an understanding. Because you look at this case study now, some of the answers will be what? Implied, while some are already contained in the case study. So your ability to understand this case study, you'll be able to provide the implied answers. Otherwise, you would only be able to provide the answers that are visible in the what? In the body of the case study. And what you need to note here is that when you are writing, you are answering this kind of question, don't be quick to just write one line and just go. No. Explain justification. Give justification on why you are making that position. It's very important. Don't just write, yes, it's correct. No, it's not correct. No, if you do like that, you're not going to get any mark because you can see that this question carries what? 30 marks. It carries in each of them, each of these question is about what? 7.5. And for you to get 7.5 in a theoretical question, you need to be able to support it. You must be able to provide evidence. So please, when you are asking questions, all these guidelines I gave now, they are very, very important. And it should be very fast when you are writing. What I mean is that you don't waste so much time. You can itemize them with your pencil so that you don't forget anything. You can itemize them with your what? With pencil so that any of those points you don't forget. It's very, very important. All right. So without wasting time, let's look at how the questions have been answered. Okay. Let's go to the solution. The first one, Ray Company Limited. If a letter of comfort had not been received, then a modified opinion on the grounds of material misstatement, disagreement about the appropriateness of going concern, assumption will be what? Will be required. As the matter is likely to be pervasive, an adverse opinion will be appropriate. However, the company had received a letter of comfort from a parent company to the effect that it will enable the company to continue with trading. If this evidence, together with other evidence such as management representation, are considered to be sufficient to support the appropriateness of the going concern assumption, a modified opinion would not be necessary, provided the support is adequately disclosed as a note in the financial statement. If the evidence is sufficient but the disclosure is inadequate, a qualified except for opinion or adverse opinion will be required. If a letter of comfort does not provide sufficient evidence, that is, if there are doubts about someone's ability to provide the required funds, the significant uncertainty arising should be drawn to the user's attention in the emphasis of the matter paragraph in the auditor's report, which will not result in a modified opinion unless disclosure relating to uncertainty were considered inadequate. Do you understand? So the conclusion here is the only senior proposal is unsuitable. The editor's opinion should be unmodified if disclosures are what? Are adequate. So let's quickly go back. We'll not be able to treat everything. Let's explain this. Let's understand this first one very well. Okay,
Hello,
before
sir.
we close. Yes, I'm with you. Go ahead.
Please, sir. Which one is a letter of comfort again?
Now, letter of comfort is a letter that gives an assurance. Okay, is a letter that gives assurance that the situation that is going on in that organization is within control. Do you understand? Do you get it, sir?
Yes, sir. Is it an audit terminology or
Yes, there is another terminology now.
letter of comfort?
See, the terminology in all this, they are much. Okay, you cannot know, you can't know everything, they are much. So what we're saying here is that you talk about the letter of comfort is a letter that gives an assurance that the organization is sufficient or is able to continue its operation without any issue. Okay? Do you understand? So most times, let me explain it. Most times, letter of comfort is usually provided when you have a parent company and a subsidiary. Do you understand, sir? Are you with
Yes,
me?
sir. Yes, sir. Yes, sir.
Letter of comfort is a document issued by what? A parent company guaranteeing to provide some form of what? Assurance as regards what? Lending, supplies to third party. So anytime you talk about letter of comfort, it's usually relating to what? When you have a parent and a subsidiary. Is that clear?
Yes, sir.
Okay, thank you. So like our time is fast spent. Let's look at it. I just want us to understand this particular one, to understand how they answer questions, not for us to just read. Now you're looking at Ray Company Limited, a subsidiary of Sun Group. You can see that we are talking about a parent company and a subsidiary. Ray Company is a subsidiary of Sun Group. You can see. So the letter of comfort is coming up there. So there is a serious going concern problem noted during the year. Ray Company Limited will be unable to trade for what? For the foreseeable future unless it continues to receive financial support from the parent company. So Ray Company Limited has received a letter of comfort from Sun Group PLC. That is their parent company. The letter of comfort states that they will support them in providing what? Finances so that they can continue to what? To trade. So, and they said here that the audit senior proposal was that the audit opinion must at least be what? A qualified except for opinion, and which is not correct. Because the letter of comfort shows that the company is okay. The company can continue to trade. So the letter of comfort has made it possible for the auditor to have issued a clean or an unmodified audit report. That will be the position. Because that letter has erased, has allayed any fear of what? Going concern. That fear of going concern has what? Has been removed. Because somebody is saying that, don't worry, continue, and you have my support. That means you don't have anything to fear. That is what it means. Okay? So it's a sufficient evidence to the auditor. So you shouldn't have given a modified audit report. I hope that is clear.
Yes, sir.
Any other question? Because of our time, right? I will implore us to, or do you want us to finish it before we close? Should we finish it before we close?
No, sir.
I think we have a next class.
All right. Thank you so much. So in your own spare time,
We can
please.
start with this next lecture now. It's not possible.
It's possible. It's possible. So we call it a day here. Thank you so much for your time. All right. All right. Take care. So next class, we'll be looking at assurance services. Okay. So
Thank
before
you,
we
sir.
start, we are going to look at this question. All right. Thank you very much.